Greetings, everybody. Welcome to Liberty Call. Today is Monday, February 5th, 2024. I hope you are having a wonderful day out there. It is a beautiful day here in Colorado. Sun's out, but boy, did we get some snow. Actually, let me, while we're chatting here, let me see if I can bring up my cameras so we can see outside. Let me go to the dashboard here. And yeah, we got go live and share. Yeah, here's my front yard right now. You can see we got a lot of snow out there, and it's about a foot deep in most places where it, like if you were to walk along the edge here, it's about a foot deep. So yeah, we got a pretty good amount of snow. And actually, let's go to the back door camera and see what it looks like out there. Yeah, you can see my back patio is, because it's kind of a drift, it's about a foot to a foot and a half deep across here. So my little boy Jake does not appreciate all the snow outside, unfortunately. But that's what's going on. Anyways, you didn't come here to talk about what the snow and everything. You came here to hear about what's going on in the financial news, right? Yes, I know. All right. Well, if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. Markets were not in a good mood today. Let's go ahead and get over to that and see what happened there. Dow Jones was down 0.71%, 274 points, closed at 38,380. S&P 500 was down 0.38%, not near about half as bad as the Dow, closed at 4940. NASDAQ down 0.2%, closed at 15,597. The VIX also was down today, 1.3%, closed at 1367. Canada down 1.01%, Brazil up 0.37%, and the Mexican markets appear to have been closed. Over in Germany, they were down 0.08%, UK down 0.04%, France down 0.03%, so those three are pretty much flat for the day. The Netherlands was up 0.21%, Spain down 1.2%, Switzerland up 0.31%, and Portugal down 0.54%. Russian exchanges both in the green today. The MOEX up 0.13%, RTSI up 0.6%. And the Asian markets, the Nikkei in Japan was up 0.63%. Australia down 0.95%. Excuse me. New Zealand down 0.07%. In China, the Shanghai was down 1.02%. The Shenzhen Component down 1.13%. China A50 up 1.97%. DJ Shanghai down 1.21%, Hang Seng down 0.15%, and the Taiwan weighted was up 0.2%. All right, so kind of a mixed day across the globe, but certainly not the end of the world. And it looks like a lot of folks are kind of digesting the, I don't want to call it bad news, but it's, people aren't getting what they were expecting, that the Fed was going to lower rates in a month or so, but it's not like I haven't said that before. All right, let's go and get to the weekly economic update. Stocks pushed higher last week as investors cheered mega cap tech corporate reports and better than expected employment report. At the beginning of the week, stocks surged, anticipating fourth quarter corporate updates from tech companies and the Federal Reserve's two-day policy meeting. This led to the S&P 500 index reaching a new record high on Monday. The market remained relatively stable for the rest of the week until Wednesday, when the Federal Reserve announced its decision to maintain interest rates within the 5.25% to 5.5% target range. The FOMC news unsettled investors who anticipated that rates would remain unchanged, but expected more specific guidance on the Fed's plan to lower interest rates. Yeah, they pretty much said that you're going to have to wait until probably the second half of the year at the earliest. On Friday, the jobs report for January revealed the addition of 353,000 new jobs, surpassing the forecast of 185,000. The strong report did not negatively impact the markets. Instead, investors interpreted it as a confirmation of a robust economy. All right, Fed's mixed signals. The Fed's decision to keep rates steady left some investors disappointed. I don't know why. There was no chance the Fed was going to reduce rates here in at the January meeting. So, as they had been hoping for indications of rate cuts in the coming months, this led to a decline in stock prices on Wednesday, with increased selling towards the end of the trading day. The Wall Street Journal's headline after the FOMC meeting on Wednesday suggested that rate cuts were possible but not expected immediately. The FOMC's policy language released after the meeting indicated a subtle shift from considering rate cuts to proposing they could be possible unless inflation becomes a concern. All right, economic data this week. Monday, we have the ISM Services Index. Wednesday, we have the International Trade in Goods and Services and the EIA Petroleum Report. Thursday is jobless claims and the Fed's balance sheet. Got a gaggle of companies reporting earnings this week also. Today on Monday, we have McDonald's and Caterpillar. Tuesday is Eli Lilly, Amgen, and Fiserv. Wednesday is Walt Disney, Uber, and PayPal. Thursday is AstraZeneca, S&P Global Inc., Philip Morris International, and Friday is PepsiCo. Maybe they should take the Pepsi challenge. Anyways, all right, let's move over to the market recap. Yep, that's what it's called. All right, let me get my notes up here. Here we go. All right, U.S. stocks faced downward pressure on Monday, influenced by a setback in consumer stocks driven by McDonald's disappointing fourth quarter sales and a rise in Treasury yields following Federal Reserve Chairman Jerome Powell's tempered stance on the possibility of an imminent interest rate cut. During a Sunday interview on CBS's 60 Minutes, Powell emphasized the strength of the U.S. economy, suggesting that the Fed officials have the flexibility to adopt a prudent, and that's in quotes, approach to potential benchmark interest rate reductions. Powell expressed a preference to await data confirming a sustainable return of inflation to the central bank's 2% target. The cautious remarks led to a reining in of expectations for rate cuts, causing Treasury yields to climb. Traders now anticipate only a 16% chance of a cut in March, down from an earlier peak of 80, and have adjusted projections to 5 cuts for the year compared to the previously expected 6. I think they'll have to change that also. McDonald's reporting fourth quarter comparable sales growth of 3.4% fell short of Bloomberg consensus estimates of 4.79%. The company attributed the shortfall to international operations affected by boycotts related to Middle East violence. Yeah, because Middle East violence is affecting how many Big Macs they're selling. McDonald's anticipated the impact of these boycotts to persist as long as as the conflict continues, adding to the pressure on consumer stocks, which suffered from an ongoing sell-off in Tesla and weakness in cruise stocks. NVIDIA experienced a surge to fresh record highs following Goldman Sachs' endorsement, with the investment bank raising its price target on the chipmaker to $800 from $625, citing robust demand for artificial intelligence chips. Caterpillar, considered an industrial sector bellwether, saw its shares rise over 2% after reporting fourth quarter adjusted per share profit that exceeded expectations, driven by higher prices offsetting a sales volume dip. Boeing, however, faced a more than 1% decline after warning of potential delivery delays due to a fresh issue in some fuselages in its 737 jets. Boeing safety scrutiny heightened recently after a mid-air incident with one of its 737 MAX 9 planes. Looking ahead, investor attention will be on upcoming corporate earnings reports from major media firms like Walt Disney, Fox, and Warner Music Group, along with results from Chinese e-commerce giant Alibaba, ride-sharing firm Uber, and chip designer ARM Holdings. All right, so a lot of news there. Let's dive a little deeper into the bond market. Bonds fall after 1-2 punch of ISM, Fedspeak, markets wrap. All right, let's see what this article has to say here. Wall Street traders witnessed a slide in bonds due to stronger than estimated economic data and signals from the Federal Reserve that dampened hopes of an imminent victory over inflation. I'm not sure who thought we had a victory at this point. We've had zero deflation at this. I mean, something might have deflated, but across the board, gas, food, all that sort of stuff, everything is 30 or 40% higher than it was 4 years ago. And until we get deflation, I just don't see why anyone's jumping up and down and patting each other on the back. Let's see here. Treasury yields surged, with 10-year yields rising 14 basis points to 4.16%. While Fed swaps almost eliminated the likelihood of a March rate move, the S&P 500 recovered from session lows, partly driven by gains in chipmaker NVIDIA. The Federal Reserve Senior Loan Officer Opinion Survey indicated that U.S. banks reported tighter credit standards and weaker demand for commercial and industrial loans in Q4 of last year. However, the U.S. service sector expanded at its fastest rate in 4 months, as reflected in the ISM's overall gauge of services, which increased to 53.4, indicating expansion. Of note, a metric measuring prices paid for material surge, suggesting an accelerated rise in costs, which again could mean more inflation down the road. Investors received this news amidst cautious remarks from Fed speakers, including Chairman Jerome Powell's statement on CBS's 60 Minutes that rate cuts are likely to be postponed beyond March. The Treasury market experienced its most significant two-day loss in months as traders reconsidered optimism about disinflation. The shift in market expectations regarding the timing of rate cuts seems justified, according to analysts. The concern now revolves around the ongoing strength of the U.S. job market in January, potentially undermining the disinflationary trend and prolonged tight monetary policy. Analysts note that while the rise in prices paid may be influenced by increased shipping costs, a resolution of conditions in the Red Sea could prompt a reversal. The Organization of Economic Cooperation and Development, the OECD, cautioned major central banks not to relax their stance against inflation. I personally don't think that the situation in the Middle East has any sort of resolution anytime soon, because you know what? Uncle Sam likes war, and the more war keeps his military-industrial complex friends, Boeing, Lockheed, Raytheon, all those contractors well fed and very fat. So now, if we all stop paying our taxes, that goes away real quick. But there's not enough brave Americans that have a spine that would actually do that. All right, moving on. The Bloomberg Markets Live Pulse survey indicated that American shoppers are unlikely to be deterred by credit card bills or layoffs, with over half of the 463 respondents anticipating strong or stronger spending in 2024. However, concerns are rising about the challenging road ahead for investors in February, historically the third worst month for the S&P 500. Artificial intelligence hype faced a reality check with big tech earnings. Speculation about an imminent Fed easing has waned, and elevated valuations are prompting caution, resembling the dot-com bubble era for some strategists. The S&P 500's recent toward rally raises questions about whether too much good news has been priced in the near term, leading some experts to expect a period of sideways to slightly negative movement in the coming weeks. Maybe today is the start of that. Who knows? All right. Then one last article here comes from our friends over at First Trust, Mr. Brian Westbury. This week's article is titled, "Labor Market is Not Adding Up." See what Brian had to say. All right. The job market in the United States appears to be strong on the surface, with non-farm payrolls increasing by 353,000 in January, surpassing the consensus expectation of 185,000. The gains are the largest in a year, and revisions in November and December added 126,000 jobs. Payrolls, including revisions, show a net gain of 479,000 in the past year. However, when focusing on core payrolls, excluding government, education, health and leisure, and hospitality, which often rises for structural reasons, the increase in January was 194,000, the best since mid-2022. Average hourly earnings, excluding irregular bonuses, commissions, and fringe benefits, rose by 0.6% in January and are up 4.5% from a year ago. The wage growth outpacing inflation is seen as good news for workers, but raises concerns for the Federal Reserve as it decreases the implied odds of rate cuts by May. However, there are details that make analysts wary. The same payroll survey showing strong job growth also indicates a concerning drop in the number of hours per worker. Private sector workers average weekly hours decreased from 34.1 in January from 34.6 in January of 2023, the lowest since March of 2020. While total jobs increased by 1.9% in the past year, total hours worked only rose by 0.3%. Moreover, the household survey measure of employment hasn't risen as fast as payrolls, a pattern observed before recessions. Non-farm payrolls increased by 244,000 per month in the past year, while the household survey rose only by 101,000 per month. This significant gap raises questions about the sustainability of job growth, especially given that payroll growth has been faster despite a low employment rate. One theory suggests that the temporary boost in the U.S. economy may be due to a large government budget deficit, including the effects of legislation like the CHIPS Act, Infrastructure Bill, and the Inflation Reduction Act. However, analysts caution that this artificial boost could soon end, leading to a sharp slowdown in job growth. While a strong jobs market is positive, it doesn't rule out the possibility of an impending recession. However, data shows that recessions have occurred even when payrolls were growing at similar rates. And actually, I touched on that last week that if you were to back out all the government spending out of the, say Q3 and Q4 of last year, would they be as robust? Well, I mean, we know that it would take some of the steam out of the economy, but how much? Would GDP have only been around 2 or 1%? Because we have a ton of overspending, and that just gets pushed out into the economy as, stimulus, work, jobs, things like that. But I call it welfare. But, other than that, who knows? And, unfortunately, most of these stats are done by, the government or government aligned businesses that, have an incentive to, provide numbers that makes folks happy. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.